No sound? Oh, it's back. Okay, cool. Maybe that was a problem. But anyway, we are back. So I'm not sure what the problem was there. There could have been a slight problem with my machine. But anyway, we've now got euro sterling, as you can see here. We are still trending lower. That downtrend is still very much in play. And I'm bringing this to your attention because in the G10 FX space, there hasn't been too much opportunity. So you've really got to look for kind of reversals and potential breakouts. Well, in this case, it's been a reversal. Let me just extend here a little bit and I'll just show you, because yesterday we ran into some key resistance, which came in around about 80 to 70, 60 to 70 level. Okay, great. It looks like the sound is on. So if you're having a problem, please do check your own machine. I'm not 100% sure why the sound is gone, and please just bear with, and we'll try to get through this. So 80 to 75, that was a 61.8% retracement of the February decline. So for example, we reached a low, which was sub 82, got to a low of 81.57 on the 17th of Feb. Bounced back from there on a mix of worse than expected UK data and potential some and maybe even some profit taking, because this cross had come so far so fast. Basically been on a complete a very a huge downtrend really for most of the past 12 months, particularly since December. The downside has been very big. So what we've seen is, as I said, the 82.75 level, we just failed. It also corresponds roughly with the 50-day moving average, which comes at 82.81. So there just wasn't much room for the upside. As you can see, today we've fallen, and that's on the back of better than expected UK data that I mentioned. Those mortgage approvals data rose to their highest level since 2007 for January. Whoever said that housing activity slows down in January, obviously not, is what we're saying. No problem, Black Cat, that you are late. Welcome. Everyone's welcome. Thank you all for joining. And we've basically reversed course now. So where could we go from here? We're looking for a daily close of 82.13. However, we think that there is room for further downside. Obviously, that a daily close below 82.14 would open the way to the 81.57 lows from last week. But then we'd have to go back all the way. Sorry, everyone. I have a little bit of a cold today. I would have to go all the way back to the beginning of 2013, the 1st of January, in fact, when we got to a low of 80.81. So we think that is on the cards at this stage, just because it looks so weak. Let me just draw this trend line coming down here. We know our recoveries have been very, very shallow, and then we failed. But again, as I said, that view would be negated if we managed to get above that 82.77 level. But if we don't, then we think we could see those February lows, or Feb 17th lows, and then potentially even the 2013 low. What you've really noticed about euro sterling on its way down, particularly from the beginning of November, is that it has very long candles. It's a very, very choppy pair. It's been declining very, very rapidly. And what you tend to get are, big periods of sell-off, then a bit of sideways movement, and then another sell-off. So, for us, the recoveries have been shallow unless we were to, as I said, break above that 82.70 level. And then get above that kind of 83, 20, 25 level would be negate our view. Our view is still very much that this pair is going to struggle, and that the pullback is going to be shallow. And as I said at the beginning, there aren't that many trends. The G10 FX market's been fairly choppy, I'd say. It's also been very range bound. And you got to take your opportunities where you can. So maybe if you don't even look at euro sterling always, it's probably worth having a look at it. Black Cat, Euro GBP struggling to cover to the upside with strong sterling. That's exactly it. I mean, you've hit the nail on the head. If I just go to sterling now, actually, let me pull up my sterling chart here. Oh, don't worry, I know this is on odd scale. I will fix. As you can see, this is sterling. Let me zoom into today's price action. In fact, I'll go on a daily chart. Today, actually, I'll do 2 days worth, so you really get, as you can see, we've had a recovery. There was a bit of a dip yesterday, but we've just recovered. We're just kind of testing around about 167 level right now. So, sterling has been boosted by a couple of things. Obviously, the better data. There was also some M&A news that has been boosting it. People are still harping on about the Vodafone Verizon deal. A lot of it was in cash. That is also helping the pound. It's always very hard to tell about those flows, though, to find the exact impact. And that seems to have been, that story just dragged out so much. I still don't really believe that it has a big impact on the pound. And I think it's much more to do with, better prospects for monetary policy that really are driving the pound higher right now. But you're absolutely right. That is certainly limiting the upside in euro sterling. What's my opinion? This is Alan. Good morning, Alan. Opinion on dollar CAD and Aussie CAD and Aussie dollar. So you're looking at the real risky end of the FX market. Let's start with the CAD. As you can see, the CAD had a very mixed week. It's had a very choppy week, and it plays into that theme that in G10 there haven't really been major directional markets. So what we've seen instead is the 112 area. So the high comes in at 112.24. That's from the 31st of January. And that's when dollar CAD made its high, looked fantastic. It then pulled back, had a really nice 2-week pullback to the middle of Feb. As you can see here, just every day, losses. However, we did manage to see, we got sub 110, but this 50-day moving average really cuts the downside nicely. So that really looks like a pullback, and it certainly doesn't look like it was anything more sinister. Then we recovered very strongly on the back of some weaker data out of Canada. And then since then, we've really been chopping around here, there, and everywhere. We haven't gone back to those lows, sub 110. But I do think it's worth pointing out that on Friday, the move back up to 112 was rejected very strongly by the market. Now, there's a couple of things I would point out about that. Firstly, that 112 obviously is a big level of resistance. It's the highest level, I believe. Let's just check on the chart. But for a number of years, I don't want to get this wrong. Since 2009, yes, that's correct. And that's, around those big levels, psychological levels, that's always going to be important. We also have, but however, the reason why we didn't break above it and why people were squaring their books is that it was Friday. That could be one reason. As we go into month end, my colleague Christopher will put something out about this later. But as we move into month end, that could be slightly dollar negative. So we could see a bit of a sharper pullback on the back of that. Dollar CAD, the focus is on the 50% retrace of the 2009 high to 2011 low. Yes, it's the key level that everyone is talking about. Let me just draw that in for you. Yeah, it comes. As you can see, 132, that is the level that everyone's looking at. It was also the prior level from, we didn't even manage to get above it at the end of Jan. It's a sticky level. And as I said, around these kind of levels, we are very, the market can be very sticky. As you can see, it still looks like a nice uptrend there for the CAD. You said some bankers were suggesting 120 by year end. And I'm sure they are. We have had, a nice pullback. 120 by year end, don't expect that to happen straight away. Just this nervousness around this level does suggest to me that that's part of the normal pattern. I think it will be a meander higher rather than a real push higher. We saw that push higher December through to January. But I think we'll probably trade it. It's very normal around big levels like that, like a 50% fib retracement of a huge move, multi-year move, right? You tend to see three things happen. Either the market rejects it, it bursts through it and accepts it and carries on with an uptrend, or it moves sideways. That's the key thing to point out. Now, I think, Pan, you've mentioned fundamental good news in Canada, US may be boosted by tapering. That's been a lot of people's argument. But then, when your position as a hostage central banker, you've got two things to be worried about. Number one, a less dovish Federal Reserve. Look, don't underestimate the dovishness of the Federal Reserve. And secondly,
a surprising Collos, who's the governor of the Bank of Canada. So he was in Sydney at the weekend, which was nice for him. He was there attending the G20, and he actually, at the G20 we knew they were talking about monetary policy. He was a lot less dovish than some expected. That was kind of the key thing to point out. Now, we have had some weak fundamental data out of Canada. Obviously, do you remember there was that January, at the beginning of this month, that real January January payrolls data. We've had, various other releases as well that just haven't been fantastic. But the Ivy Purchasing Managers Index actually bounced back in January. And so we've seen a bit of a turn in the data. The employment change was slightly better as well for January. So it was the December number that was really, really weak. Basically, the December data was really messed up. It didn't look fantastic. I'm not saying that every bit of data has been fantastic in Canada. It hasn't. For example, retail sales are still very weak, but we have seen a CPI pick up from the base, seen a bit of a recovery in the employment side of things and in that Ivy manufacturing data, which suggests that that sell-off that we saw in the Canadian dollar may not have been as justified, and hence why we're just going to take our time. That doesn't necessarily mean, if the US can really recover from the weak start of the year on the back of the data, on the back of the weather, then that probably, we could definitely see a continued recovery in the dollar. But I think the main problem of why we're seeing the CAD really hesitate at this 50% fib level is since we will is largely because the dollar is just struggling right now, and that could make it just a little bit wary above these levels. However, the CAD has been one of the worst performers against the dollar in recent sessions, so it's good to point out. But it's just there's no real direction at the moment, purely because the dollar just doesn't seem to be able to gain any traction. Now, Alan, you've mentioned Fed data from Canada will be weak too, since the snowstorm will impact Canada. I'm sure, if you're based in there are lots of snowstorms in Canada itself. Definitely by far the coldest place I've ever been to in winter. But right now I'm looking at, there's so many moving parts, I think, from a fundamental perspective. It's worth looking at it from a technical perspective. So if we do manage to clear that level at 1532, that opens the way to a broader based recovery, potentially back to 116.64. That's a 61.8% fib retracement of the same move that we're talking about here. Okay, everyone, let's look at euro. For those of you who follow our research, we put out a report yesterday, just saying, the real tough level that's coming up for euro dollar. It really is going to be a bit of a struggle. In fact, I'll just send it to you now. Critical resistance there at 138.35, at 138.33. This is a massive level. In fact, I have to go all the way back. Then let me just change my chart to a line. This is a massively significant level. Trend line is going all the way back to 2008. We also have trend line resistance. We also have the 61.8% fib retracement of the May 2011 to January to July 2012 downtrend. I'll just draw that in as well. It's going to get a bit messy, this chart. Apologies. They all coincide around about this level. The 61.8% retracement is actually slightly higher than that because of this is a line chart rather than a candle chart, but it's better to look at this line chart better look at this on a daily to start with, but also on a line chart rather than a weekly at the moment. But as you can see, we are looking, it is looking just very hesitant around this big level, as one would expect. I mean, this is significant. It's multi-year. It's a multi-year trend line. Everyone has to, it's definitely going to be, a sticky level. People are going to consider it before they push it one way or the other. So we are clearing on now. Where are we now? 137.5. We have been as high as, let me just get that data for you. we're basically stuck in a really annoying range. In fact, I'll get the range for you now. I'll just put it down here. As you can see, that is range-bound activity if ever you've seen it, ahead of this major level, which is very normal. As I said at the beginning, around big levels, you can see three things happening. You either reject it, you go through it and you accept it, or you trade sideways. And as this chart shows, this mini chart in the middle shows, we're moving sideways on it. So what we're seeing right now is it's just, certainly a bit of hesitancy. What could drive this pair one way or the other? Eventually, right, the market's going to have to make up their mind. Black Cat, you're saying pretty much range bound since the start of 2014. Absolutely. I mean, you can see it from here, right? Pretty much range bound, nothing too exciting going on, which has been frustrating to a lot of people who've been looking for it to fall or potentially get up to that 140 level. It just hasn't done it. So, when you get close to these levels, moving sideways can last for a while, but the range has been so narrow, we think it will break out one way or the other. And a few fundamental events could determine this. From the euro side, we've got CPI, the estimate for February, which is coming out Friday. That's going to be critical. The market is expecting a drop back to 0.7% up after an upwardly revised 0.8% for January. If this is stronger than expected, then that could be the trigger. Obviously, inflation is very important right now because if inflation is improving, it means it's less likely that the euro is going to, or that the ECB is going to take more accommodative policy action. The potential for more accommodative policy action has been one of the main things, really, that has been, limiting euro upside, I should say. So if it looks like the ECB aren't going to do anything, then, we could easily get above this level, maybe even then get back to the 140 level, key psychological level, the level that, we've been around and the market thinks at that 140 level. So that's worth watching. The other thing to point out is the ECB meeting itself, which comes out the week after. Obviously that's coming straight from the horse's mouth. So that's going to be critical for this pair. And we could just range trade into it. So sorry, for some of you who are looking for maybe slightly more action. I think there will be more action. I'm just saying be patient. Watch your levels. Know if things aren't moving for you, don't rush in. Instead, just kind of hold back, pull back. Just see how it goes and just wait for those major fundamental events if you prefer. Otherwise, it could be a rather frustrating time for you. Now, the dollar, euro dollar isn't just made up from the euro fundamental side of things. It's also made up from the US side of things. And next week, the end of next week is going to be really critical. We also get the US non-farm payrolls report for which will be for February. That's going to be obviously very important for the dollar to see whether or not the weather impact just comes out of the dollar, and the February data really puts us back on a more sounder footing, a clearer outlook for where the US economy is going. There's a lot of expectation there that the US economy will continue to do well once we get this weather stuff out of the way. If that happens, that could be what triggers the US to move higher. Now, Yeah, I mean, I think Black Cat, you make a good point here. It is what it is. The important thing is to recognise the context and trade accordingly. Absolutely. Very sage advice. And we can't force the market to move. No, you definitely cannot force a $5 trillion a day market to move. But what I want to show you is just to move on slightly. Actually, I'll do it with this one. Ooh, sorry, guys. It's all gone a bit funny. You bring that up. So what I want to show you here now is, just whether or not the market, the inability of the dollar to rally has been a very frustrating move, because I know a lot of people were expecting a good dollar rally on the back of for 2014, and that hasn't happened at all. So we've seen, weather beaten data. Oh, what am I doing? Sorry, guys. Here we go. We've seen a good, there was a lot of expectation the dollar would rally coming into 2014. It hasn't. So where are we, and what does this mean? So we've had this weather impacted data. It's been much weaker than expected. People are thinking, I don't know whether to believe it because it's weather impacted. We also have the Fed, even though they sound quite dovish, they're still sticking to their tapering. And what we've seen is treasuries move one way and the dollar index move the other. So the dollar index and treasuries, they have diverged. It's not perfect correlation, as you can see yourself, but during these real stark periods of divergence, it's worth taking a breath. Because what in the currency market, it's basically said, okay, weaker data out of the US, even though it's weather related, we're going to sell the dollar. And yet in treasuries, the yields are moving higher, which is suggestive that, the market thinks the recovery is ongoing and will continue. In fixed income markets, investors tend to be slightly longer term, hold positions for longer. In the FX market, it's all quite quick. So that could be one reason, is that basically the FX market is thinking about the here and now. The fixed income market is looking ahead. And what we're seeing is this divergence. What does that mean if we trade FX? Well, if we see the data from, from the February data or even the March, so basic data from next week onwards, start to improve, then the dollar really has some catch up to play. And we could see the dollar index reverse course back away from this 80 level, which has acted as very good support pretty much since November for the last 3 months. And we could see it kind of push higher back up to 81. So that's kind of the level to watch. There's also, I just want to show you the dollar index here, because 81.19 is the key level to watch, really. A lot of the dollar bulls are not going to be happy until we get back above that level. That's the 200-day moving average. A lot of people's minds on that. I know some of you won't trade the dollar index. Always worth looking at, though, because it's a great way to get a real grip on what the dollar is doing. Okay, dancing around, dollar index dancing around the 80 level, that's true. Pan, you're funny there. So let's look at gold. No, I haven't looked at gold yet. I was too busy with some of the other crosses. As you can see, this is a daily chart. Nice push higher. The 200-day moving average still cupping the downside there at 13.01. Struggling a little bit today. There's a bit of a risk-off tone to the market. We haven't been, this is just a 5-day chart, just a kind of tick chart, really. As you can see, that 1340 is struggling a little bit, and we've backed up away from there. 1320 looks at good support, very good support. That is the low. That was one of the lows from yesterday, or the low from yesterday, sorry, or it actually comes in at what? Let me just get 2 days up. Comes in at 318.91, so about 319 was the low. And we've just not really managed to sustain that level around above 1340. Let me just draw in. One of the reasons why, as one of my colleagues has pointed out, that is a 61.8% fib level of the August high down to the December low there, which comes in around about 1340 level. And that's why it's 61.8% fib retracement of that move. And that could be one reason why gold has been sticky. The other reason from a fundamental perspective is that it's kind of moving with stocks. Stocks aren't really moving. Investors just aren't. There's no kind of oomph in the market. Now, that's very typical of the last week of the month. We don't really have as many fundamental drivers. Things have been calm-ish. We've seen a bit of a push higher in stocks, but nothing massive, even though we have reached fresh highs. The actual percentage range has been quite low on a daily basis. Right now, I can't believe it. I mean, yesterday everyone was saying that risk appetite is real bad. It's back so good, and yet only, the S&P 500, even though it did reach a fresh intraday record high, was only up 0.6%. This isn't your typical, bull market conditions. But, happy to eke out gains where we can get them. And so, that could also be limiting gold upside. So someone thinks the euro is being manipulated. Guys, that's for your conspiracy theories, maybe elsewhere. But I'm happy to take one question if anyone has one. I know we've got another couple of minutes left. Preferably not on conspiracy theories, though. Any predictions for March? Well, I think it's all going to be, I've got my crystal ball. No, I don't. But I think it's all going to be dependent on that first week. So next week, I think it's going to be really critical. Next week, probably leading into payrolls, it's going to be quite quiet. But we have payrolls, we have an ECB meeting, lots of expectation around them. Ask me in 2 weeks' time, Black Cat, and then hopefully we'll come up with something. But just to leave you with this, I'll just show you a chart with the S&P 500. But I think, if we are, in terms of predictions for in terms of predictions for March, everyone's still waiting to see if the dollar will rally. What I think is that we need to see to get the dollar to rally in any meaningful way is a turnaround in the data. So I'm not just being flippant there. I'm hoping that we're all hoping, right, that the data will improve and will be just weather related, so that we can get a theme going. Okay, so there you go. The high yesterday was 1858, but as you can see, for kind of a rally to record highs, it's quite pathetic, isn't it? Very tiny little ranges, very hard to get into. Probably much better for the people who have been long for a long time. If you got in long there, you don't really mind if we're getting a bit toppy here. But I still think just the lack of follow through could still make people nervous and make people kind of book profits as we get to these record highs continually. Book profits. And if it's all to do with kind of M&A activity, and that's driving markets higher, then, we need to get more than it can't just be M&A activity. Today, for example, we get consumer confidence out at 3:00. That's going to be really, really worth watching quite closely, and then we'll move into there. Then we'll, know that's for February. It's one of the earliest February releases. At that point, we'll know if the data was just kind of weather impacted, or if maybe there is, and can recover, or if it's something more sinister. So watch out for that consumer confidence data. That's going to be critical. That could be whether or not we get to 1860, 1870, even to 1900 in the S&P 500. Okay, everybody, I'm going to leave it there. But thank you all so much for joining. It was great. Also, thank you for those of you, I don't know if you know, but we won the best analysis in FX Street for its best awards. So we're really delighted with that. Thanks to everyone at FX Street and for those who voted for us. And we really appreciate your continued support, both FX Street, but also all of you guys that join, that share your opinions. I know some of you have been coming for years, and we really do appreciate it. And thank you all very much.